At this point, the story about the collapse of one of the leading commercial banks in the world, Silicon Valley Bank, is no longer news. The recent collapse has the whole economic world shaken. From big-time investors to stockbrokers and even the random dude with a bank account, financial establishments today are a ruckus. But the collapse has happened. So what's next? Stay with us in this video as we take you through our predictions concerning the collapse of Silicon Valley Bank. You don't want to miss out on the info needed to put you ahead of the curve, so stick around till the end. It's no surprise how shaken the market has been since the collapse of Silicon Valley Bank. This bank was not only America's 16th largest commercial bank, but also provided banking services to nearly 50% of tech and science companies in the nation. From Canada to China to Ireland, Sweden, Israel, Denmark, Germany, and even the UK, SVB has opened numerous operations since its establishment in 1983. The bank's success and expansion over the years were augmented by the pandemic-induced boom of digital and online services. But even before that, SVB had greatly benefited from the recent rapid growth of the global tech sector as well as the ultra-low borrowing costs they offer. The bank's assets tripled from $71 billion at the end of 2019 to a peak of $220 billion at the end of March 2022. Every tech startup headed to one SVB to deposit their cash, moving the total deposits from $62 billion to $198 billion over the same period. Clearly, the bank was doing so well, and that was the case up until early March 2023. It began on March 8th when the lender announced that a bunch of securities had been sold at a loss. But that wasn't all. SVB also announced that it would be selling $2.25 billion in new shares to cover the financial loopholes. Turns out, that announcement was the worst possible way to go about things, and 48 hours later, the bank had stopped trading in shares. Customers panicked and began to withdraw their money in large amounts to avoid being victims of another global financial crisis. Bank stocks plummeted, efforts to raise capital or find a buyer failed, and SVB had to be shut down by the state of California. Silicon Valley Bank was also placed in receivership under the Federal Deposit Insurance Corporation. If you're wondering what that means, it's simply that all of the bank's assets will be liquidated to raise funds to pay back depositors and creditors, all under 48 hours. Or so it seemed. Many people are unaware that an approaching collapse has been brewing behind the scenes for years. SVB had begun putting billions of US dollars into government bonds during the near-zero interest rates era. Not that anyone could fault that move at the time, we mean it was a safe bet until it wasn't. The Federal Reserve began hiking interest rates aggressively to tame inflation, and here's a simple principle on how that works. Interest rates rising results in bond prices falling. We're not saying SVB didn't understand this simple system, but someone in the bank wasn't paying attention to the metrics until it was too late. However, with the market in a state of unrest, because one of the big banks has crashed, it's important to not get ahead of ourselves. It's vital that you don't panic about investing or taking out your money because of the meltdown either. That's where we come in with our expert predictions so you can tell what the future of the banking system looks like in light of Silicon Valley Bank collapsing. The United States Treasury Secretary Janet Yellen already spoke on the matter, saying, quote, unquote, "Let me be clear. There were investors and owners of major huge banks that were bailed out during the financial crisis. The reforms that have been implemented imply that we will not do so again. We probably don't need to tell you, but this is just a government official trying to calm the already nervous emotions of people." The U.S. Treasury eventually began to reimburse everyone for their lost funds on Monday, March 13th, but it's not all that simple, at least not based on expert predictions. First of all, the Federal Reserve and the U.S. Treasury taking action was in no way an act of goodwill or something. In fact, a failure to act would have been a dereliction of duty on their path. Allowing customers access to their deposits prevented a complete loss of confidence in the national banking system. Even the government can't have that. Not when it could lead to a run on the banks that can cause a liquidity crisis and trigger a full-blown global financial crisis. One effect of this collapse will be a possible restructuring of the law in light of the Trump-era deregulation of banks, partly contributing to SVB's collapse. The law being in place has caused a large extent of oversight and capital requirements, and these, more than anything, lead to collapses like this. The legislators will have to revisit those laws and fine-tune them to serve the interests of keeping the banking system efficient more than anything else. Another important thing the collapse will cause is a slowdown in the Federal Reserve's plan for aggressive interest rate hikes. January and February 2023 saw some crazy hikes, and many were expecting another hike before the end of March. However, as things stand, they might just have to slow down on that plan, or better still, bring it to a total standstill. What else can be predicted about the nature of the market since Silicon Valley Bank's collapse? This might seem obvious, but we can't go without mentioning that the tech industry will have to learn from this crisis. And by have to, we mean it as a compulsion. Agreed, since the pandemic, there has been a readjustment of the tech sector over the past 12 months. A difficult readjustment. Over the last 18 months, the combined values of Alphabet, parent company of Google, Amazon, and Meta, parent company of Facebook, have dropped by half. These red flags might have gone unnoticed in SVB being a predominantly tech bank. Yet, the looming collapse of a major bank has surfaced. One thing we can be sure of as a result of the collapse is that there would be moments of reflection for those involved in the tech sector. They'll finally be able to focus on delivering authentic value rather than just making profit. That approach to business has always been unsustainable and will lead to a black mold of trust from end users and customers. Clearly, the SVB collapse has taught everyone how important it is to retain customer trust, so change can definitely be expected. Not only should the tech sector reconsider, but also look for ethical value exchange-based organic growth to improve and retain customer trust. If you take this as a positive prediction for the market, then here's another. We also expect the collapse of Silicon Valley Bank to result in a more work-friendly environment for stakeholders of all levels. Everyone has been given a reminder of the importance of the first principle of diversification. We've already seen it, and we expect it to last even longer. Solidarity between stakeholders to show support for each other and have one voice in addressing the government's bank policies. It was only a matter of time before it was impossible to ignore the fact that every business in the same sector, as much as they're independent, are all pieces of dominoes. The collapse of a singular bank has shaken the whole stock market, and it's clear that stakeholders need to work together on certain levels because one collapse affects everyone. According to Yannis Mouse, the founder of Birmingham Tech, the sale of SVB UK to HSBC is also a positive and a big opportunity for the tech sector. Yannis said, and we agree, quote, unquote, tech companies will now have access to the same SVB capabilities they have always appreciated, but through a bank with a worldwide reach and connections. This should provide tech companies with the desire to go global access to significant resources. HSBC also provides extra technological skills, most notably a £250 million fund to help high-growth digital companies. This couldn't be any truer, but with yin comes yang, with good comes bad, and with the positive comes the negative. So let this last prediction ring as a sound warning to everyone on the market. This sudden downfall of SVB will open the door to a wave of cyber criminals. Many sophisticated spear phishing campaigns will come up, and many will try to create fake government notifications to rescue SVB funds. Others will come up as a third-party offering facilitated access to loans with countless startups and companies affected by the collapse's targets. And the bitter truth is that some will fall victim to these scams. Even the seemingly prudent tech dudes will become less prudent, hoping for some kind of breakthrough to recover the millions lost due to the collapse. But what you must do to prevent falling prey is to scrutinize every email you get, every fax, every piece of info that drops on your lap talking about the SVB rescue, loan, or credit. For those affected by the crisis, they might have even lost their cybersecurity insurance. We're here to tell you that is fine. It's rock bottom for most, and the only way now is up. So double-check your calls and texts, be skeptical about offers that sound too good to be true, and in simple terms, stay strapped. You won't want to get caught slacking during hard days like these. Do you need further explanation on any of these predictions? Or maybe you have questions or additions to make? Let us know in the comments section, and don't forget to like and subscribe to our channel.